Good morning, gentlemen. Thank you very much for your time. It's allocating time from the UK. I believe that you've got some interesting times. That's playing around at the moment as well. Our conference center has definitely changed. I mean, we're very effective during these times, and it's good to welcome you guys to this forum as well today. The intention, as I mentioned, would be to give a bit of feedback in terms of how Credo sees the world, how we went into the COVID debacle. We saw COVID, we saw oil, we saw it just as tariffs settled down. We saw tariffs over the weekend popping up again. Indeed, interesting times. Dion, would you be able to talk us through your views in terms of what you see and how you interpret what's going on?
Luciano, yes, and thank you very much for the opportunity to you as well as your clients. Of course, I've met some of the clients that I think will be watching this on one or two occasions in the last couple of years. And the most recent one was just more than 2 months ago in Pretoria. It was the last week of February, if I remember correctly. It was only about a week or so after the recent top of the market. And of course, COVID was already a news item at that point in time. And we were discussing it on the day. I vividly recall some of the conversation we had about that. But to be honest with you, even as recently as 2.5 months ago when last we met, I'll be the first to put my hand up and confess that I certainly didn't foresee the consequences as they've been playing out subsequent to that last week of February. I don't think any of us, certainly not me, could have imagined a world going into lockdown and the global economy grinding to a halt. I honestly never expected that. And clearly it has had an impact on markets and portfolio positioning. And just having framed it like that, I think I will actually go as far as saying that this is probably the biggest black swan that I've seen in my investment career. In fact, not only the biggest one, it's one of very few that I've seen. The black swan was popularized by Nassim Taleb in his various books going back 20 years now. I've been in the markets now for about 25 years. And I can honestly say that out of all the market dislocations that I've experienced, this is not only the biggest one, it's probably one of the only ones. The only other one that I think compares in a very different way would be September 11. We can look at the emerging markets crisis of 98 or the tech bubble of 2000 or the global financial crisis of 2008 or various other hiccups that we've had along the way. And none of them were really black swans. Even the financial crisis in 2008 had elements of forecastability to it. And I'm not trying to suggest that I forecast the whole crisis and everything that happened as we went through it. But you only need to read a book from Michael Lewis, the Big Short, or see the movie, and you'll understand that there were elements of forecastability, and indeed there were some managers that made a lot of money out of it. Whereas with this one, go back 3, 4, 5 months, I don't think anybody really saw it coming. And if somebody did, then I'd like to meet him and maybe give him my money to manage as well. So it has been an unprecedented time. It's been very difficult, I think, to get through it without any scars. And of course, Jared will speak later about our own portfolio, how we've tried to respond to it, where we are. We've had some winners, thankfully. We've had a few losers. He will address that as well. But I just thought I'd frame the conversation by talking about the kind of extent of the event. I've got only a few more introductory remarks, and I will structure it in sort of 3 main bullet points. One is about the expected shape of the recovery, because a lot of people are talking about that. 2 is just some big picture comments about the markets as we've seen them in the last couple of months in terms of some of the big swings. And then finally, some thoughts about, future positioning. So firstly, the shape of the recovery. A lot of people are asking, what do we think? Is it going to be a V shape or a U shape or a W shape or an L shape? And I'm hoping that viewers and listeners all have an understanding of what all these shapes mean. But let's talk about the V shape first, which is the one that obviously everybody hopes for. I think that's probably over-optimistic. A V shape is one that goes straight down, as we've done, and then reaches a turning point and basically goes straight up as quickly as it went down. Now, I think that's unlikely. The only possibility of a V shape happening is if miraculously we have a vaccine that gets discovered and gets authorized by the FDA and gets rolled out commercially successfully on a large scale within the next few weeks, the next few months. That's not impossible, but it's unlikely. It would be wonderful if we had that news, but it's probably unlikely. The U shape is similar to the V in terms of the extent of the drawdown and also the recovery. But of course, the change happens at the bottom. It's a longer drawn out phase that you spend at the bottom before you start going up. So rather than a few months, this means maybe a year or two. And I would suggest that that's maybe the most likely. Some people would accuse me of being over-optimistic by believing that a U-shape is possible. And that may be so, but I will back human endeavor and ingenuity ultimately, and also all the work and money that's being thrown at it. I think a vaccine is likely to be found and likely to be successfully rolled out within the next year to 18 months. And if that is the case, then I think we can return to normal in most ways. We can go to the workplace and don't worry about social distancing. We can probably get on airplanes again and sit next to each other, and we can enjoy mass gatherings at football and in the pub and elsewhere. But I think it will take a year or more, and that ultimately will feed into a U-shape. There's a different version of the U-shape about a week ago, and I thought that was interesting. And that's what people refer to now, not as a letter, but as the Nike swoosh. So it's likely U, but the leg that goes up just goes a bit more slowly. And maybe that's a more prudent version of the U-shape. So I'd say in an optimistic scenario, we'll have a U in the next couple of years. And in a more pessimistic scenario, it'll be the swoosh. It'll go up maybe slightly more slowly. I will never say there's going to be an L shape. An L shape means that you go down to quite a dark place and you stay there for an extended period of time. The horizontal leg of the L. I'm simply not that way inclined. I think markets will recover. I think there will be a vaccine. Ultimately, you have the likes of Elon Musk and Bill Gates and brilliant people all working on different things in the world. So I'm ultimately a glass half full sort of person. I just don't think we're going to have an L. So those are my thoughts about a prospective recovery. Then just some overview comments about what we see in the markets. Of course, as I said, when last we met, it was the end of February. Since then, markets had a drawdown, a very sudden drawdown over a period of less than 4 weeks of 34%. And towards the end of March, there was a huge amount of uncertainty, a huge amount of pessimism and negativity in the market. And I have to say, I'm also human. We were tested. Jared and I had some incisive conversations about this, asking ourselves, should we capitulate as well? Thankfully, we didn't. We didn't put at the bottom, and that ultimately is what one shouldn't do in times like this. And since the bottom, which happened on the 23rd of March, I'm just looking at the updated number here. At the close last night, the S&P recovered by about 27% from the bottom. Now, unfortunately, the way mathematics works is when you go down 34% and you then go up 27%, you're not down 7, you're still down 16. So we're down 16% from the top. We're down about 12% from the 1st of January. But interestingly, if you take a 12-month view, we are in the first week of May now. If you look back to where markets were 12 months ago and you include dividends, we're flat. The market is flat over the last 12 months, including dividends. We're down 2 or 3%, but we're flat, including dividends. In fact, we're back. Even if you ignore dividends, we're back at market levels where we were in the second half of August last year. So in the last 9 months or so, we've basically gone sideways with a lot of excitement, of course, but sideways over 9 months, and that doesn't even include dividends. And that has surprised many. A lot of people ask us, how is it possible that with this huge economic dislocation, with tens of millions of people out of work, with numerous companies that are bound to fail in the coming months, the next year or two, how is it possible that the market could go up 27% in a month? And my response to that is threefold. I think firstly, you've got to understand that markets are discounting mechanisms. The equity market doesn't look at the next earnings announcement. It doesn't look to next quarter. It doesn't even look at the next financial year. It looks further forward, and it looks to the recovery. It looks to that strong up leg in the U shape if and when we see it. So that's the first point. Markets look forward. And that is what they've always done. The markets and the economy don't always react in the same way, certainly not from a timing point of view. Secondly, the stock market and the real economy have a tenuous link at best. Yes, they measure the same thing. They measure economic activity. They measure money that's being made and lost. But ultimately, the economy is made up of lots of large companies, lots of small companies. And a lot of small companies will fail because they won't be resilient enough to withstand this. But a lot of the largest companies will probably get out of this stronger. And you just need to look at all the big tech companies that make up, the biggest constituents of the index. Microsoft, being the biggest company in the world and one of my favorite companies, and one that I've spoken to your clients about on numerous occasions. In fact, the day that I last saw you and your clients with Johnny, you may recall I bought some Microsoft that day. Hindsight, it was slightly too quick. I bought it at 160. It fell down to about 135. Now, thankfully, my purchase that day of 160 has now gone up 10%, but it's gone up 10% after first losing more than 15%. But a company like Microsoft will come through this stronger. We are sitting here chatting today. We are doing this on Teams. Microsoft has had tens of millions of Teams meetings in the last few months. I kid you not that 6 weeks ago, I didn't even know what Teams was, and now I'm an expert. And that's just an additional, piece of business that Microsoft will benefit from. So the bottom line is this: the market is not the same as the real economy. The florist in your high street may fail, but Microsoft is benefiting. And Microsoft, as I say, is 2% of the MSCI All Country World Index, followed by the likes of Amazon and Apple and Alphabet and the likes. And then finally, when it comes to markets, I think the most important thing, and this is what happened on the 22nd, 23rd of March, is the Fed came out with unprecedented announcements in terms of what they can do to financial assets. And of course, there's a lot of people, that don't like what the Fed is doing. They say that the Fed is artificially inflating markets, that it's not sustainable, that it's creating bubbles. And you can have your opinions about the Fed, but in 25 years in the markets, I think that if there's one mantra that I've learned that probably dominates everything else, and I don't say this lightly, it is those few short words that says, don't fight the Fed. And you only needed to look at Warren Buffett on the weekend to look at the complimentary remarks that he made about the Fed and the actions of Jay Powell at the end of March. If the likes of Warren Buffett doesn't want to fight the Fed, and if he's complimentary about Jay Powell today, after 89 years of investment experience, then I certainly don't want to bet on the other side. And then finally, some thoughts about, the future of the markets, the next few weeks, the next few months. And I think the honest answer, as always, is that, the path that markets is likely to follow going forward in the next few weeks and months is ultimately unknowable. We'll discover it as we go along. And the bottom line is, I think, not to try and trade it, not to try and be too clever, not to try and sit out because you're waiting for the next down leg, as a lot of people have done, not to go all in because you're overexcited because of news flow around maybe a vaccine or an antibody test, but to do what we've always done, which is to make sure that people's portfolios are structured in accordance with their risk profile, to make sure that people embrace the risk, because ultimately that is, what they're rewarded for, assuming that they've got the appropriate level of risk in their portfolio, and ultimately, to build a portfolio of quality assets at reasonable prices in companies that hopefully you understand, and hopefully you get more right than you get wrong, because we will make mistakes, and then ultimately to ignore most of the news flow. Now, of course, it's been impossible to ignore the news flow around coronavirus. It's been, an all-prevailing sort of barrage of news, and it's affected all our lives, and I accept that. And as I said this earlier this morning, I'm also human. We all are. We've been affected by this. But the bottom line is, it's pointless to try and forecast daily, weekly movements. So we stick to our knitting. We've got a very simple and old-fashioned investment philosophy, and that ultimately leads to some of the positions that I think Jared will give us some color in terms of the constituents of the portfolio and how we've behaved in response to all these market developments over the last couple of months. So I hope that helps in terms of framing the conversation. And on that note, I will hand over to Jared. Thank you.
Oh, thank you, Dion. I really appreciate it. So Jared, would you mind just talking us through the mechanics of the portfolio? I mean, so Credo being a value asset manager, moving into the early March sort of cycles that we saw. How were we positioned, or are you positioned rather, relative to how the market reacted, and how did that sort of play out over this period?
So, I mean, if you just track back to February, you may recall that we were relatively defensively positioned mentally anyway. In the one portfolio we had one placeholder, in the other portfolio we had two placeholders. So effectively 5% cash and 10% cash. And we were struggling in terms of valuations in the market. But clearly the virus and the pandemic that's happened since then has been, as Dion's alluded to, unprecedented. And the impact has been, fascinating. It really has. But so let's start when in February we saw the pandemic in Asia. We were concerned that the pandemic was going to have a devastating impact, particularly on the Asian environment. And the first thing we did was sell Las Vegas Sands. Macau-based, we were concerned again that you could see the casinos shut down for up to 6 months, and that would have devastating impact on revenue. So we sold Las Vegas Sands out of the portfolios, which in hindsight was a great trade. Timing-wise, we could have possibly massaged that a little bit better, but we don't try and time markets. We then actually added another stock to the portfolio, a stock called Progressive, which is a big American insurance company. And we were quite happy with that purchase because even during this COVID time, Progressive has actually been one of the better performers. We marginally down on the stock. And interestingly, Progressive is one of the stocks that benefits in the environment today, in the sense they're a big car insurance company in America. Less people on the road right now, less liabilities for them to pay out. And it's come to a point where them and Allstate, the two big providers of car insurance, have actually given back some of the premiums to their customers for goodwill measures over the last couple of weeks. So that's been a relatively positive addition. But I guess just getting into the nuts and bolts of what happened going into the end of Feb, beginning of March, how we reacted or didn't react, because I think for a lot of stakeholders and clients of yours, they may look at the portfolio and say, well, what did you guys do? It's pretty static. I mean, you didn't sell, you didn't buy. What great opportunities. And one of the terms that's come out of this, which is quite enjoyable, is a term that some of my clients have framed, which is called FEMO, which is the fear of missing out. Whereas historically we had, sell at the bottom, sell at the bottom. All of a sudden you've had this bounce in the market, and now everyone's like, I want to be in, we've missed it. So it's very interesting how we've had this behavioral finance during the period. But going back to how we were thinking about it, clearly, as Dion said, no one anticipated anything as significant as this, and the extent and the severity and speed at which the markets actually capitulated were very difficult for fund managers. So the first thing we try to do in terms of a mitigation and risk strategy was look at the balance sheets of our companies. So which companies in an environment where debt and equity markets effectively had shut down. And if you go back to the days just prior to when the Fed did step in, there was a real serious chance that some of the best companies in the world that were leveraged just wouldn't have access to any capital. And we were taking the view that this could be for the foreseeable 6 to 12 months. And with a fine-tooth comb, we basically went through every single stock in the portfolio and say, what's vulnerable, what's got the likelihood to hold cash, what's got debt facilities. And these are fairly opaque things in the sense that you don't spend huge amounts of time in terms of revolving credit facilities. It's one thing to say, well, Facebook's got billions of cash on its balance sheet and they'll be okay. But when you look at a company like Meggitt and you think, well, they leverage, but can they access bank debt? Will they have to have a rights issue? If they're going to have a rights issue, is there going to be any appetite for it? And that's kind of how we went through the process. And we marked all the stocks in terms of survivors, don't worry, can hold out for extensive periods of time. And then there's a kind of a red dot about a couple of stocks in the portfolio that were looking a little susceptible. But in truth, those stocks, you saw it in the price. The market was very reactive. And anything with leverage, anything with a weak balance sheet, or anything operationally with, a very large capital structure was just marked down significantly. And then the view we had to take was, well, do we cut? Do we take it, capitulate, sell at the bottom effectively, or do we ride? And the significant change happened when the Fed stepped in and they started buying all types of bonds, because the capital markets or the credit markets instantly came back on tap. And that created the liquidity for everyone. And all of a sudden, the bond markets were functioning again, the equity markets were functioning again. And then over the coming, or the forthcoming 2 weeks, we saw some extraordinary bounces in the market, and stocks that we don't own. But for example, a stock like ASOS, which is a good business but was highly leveraged, was trading at £10. They happened to have a rights issue at a premium to the share price. And within 3 days, the stock had doubled. And we were looking at these kind of stocks and thinking, these are really, interesting situations, but the downside, just there's no protection. All of a sudden that changed. But just going back into the portfolio. So again, we've kind of gone through it and we've taken a view. Yes, we know there are a few stocks in the portfolio, which I'll talk about, that are problematic, and the long-term prospects are looking a bit dubious at the moment. But because they're trading so distressed and there's so much negativity in them, some short-term catalysts or any type of good news could lead to a relative bounce. And the way I think of the portfolio, maybe your clients should think of it, is this kind of barbell type approach, where you've got the front end, where you've got a block of stocks, and then you've got the middle slither, which are the kind of holding stocks that are performing okay, and then the back end, which are the don't want to call them problematic, but stocks which you could see in this kind of environment that could go negative or more negative, or if there's some element of good news, could be the best performing stocks over the next 12 months. And it's easy to say, well, why don't you just front load your portfolio with the kind of corona protected stocks? And we try and do that. And if you have a fund approach, you have a better timing type of scenario where you can, be defensive, be more corona friendly. And then if you see or you feel the rotation coming, you rotate out of them. In a best ideas or dividend growth portfolio where you have a binary type of situation, you either in or out, you can't. So you've got to massage your thought process and be a little bit more disciplined in terms of what you're thinking. So on the front end, obviously the stocks that have performed well and are likely to perform very well if we have a sustained period of lockdown are companies like Microsoft, as Dion's alluded to. The enterprise side of that business has just absolutely flourished. And one of the comments on the call was what they've achieved over the last 2 months would have taken them 2 years to achieve in a normalized environment. So they are really benefiting from it. The stock price has become relatively elevated, as have a few other IT companies. But I think the market's prepared to pay a premium right now for unbelievably qualitative type of businesses that have massive amounts of cash on the balance sheets and operate just about in any type of environment. So in a sense, Microsoft's become bulletproof. And, it's the biggest holding in our portfolio, and the share price performance has been incredible. And then alongside that, you've got the Alibaba and AIA, which I'll bucket in terms of the Asian stocks, which ironically were the first stocks that instinctively I was thinking of possibly lightening up or selling when the crisis hit Asia. But, as they've managed to manage their pandemic a lot better than the rest of the world, Alibaba has been a stellar performer, and AIA has actually performed relatively well as well. And I'll compare AIA with Prudential, which is actually in the bottom side of the bucket, which has underperformed. But I'll talk about Prudential a little bit later when I talk about the insurance bucket in terms of the problematic stocks. Then you have a company like IG Group. IG Group is a CFD provider in the UK. We bought it really cheaply, dividend yielding 7%, 10 times multiple. Market didn't like it. And a company like IG thrives on volatility. So you've actually got a hedge in the portfolio. And again, it's reaching, I wouldn't call them all-time highs, but certainly the highest it's reached in the last 2 to 3 years. So we think a great coronavirus type of stock. And then Progressive, I've spoken about. Verizon's another one, very defensive. Can you imagine the amount of air traffic that's going on in the States? I mean, we're sitting here, I'm not using my internet anymore. I'm using my data because I want a secure line. And there's a lot of traffic. So they're actually benefiting from this type of environment. Also, because you have direct debits, it's a utility. So Verizon's done nicely. And again, it's been a good defensive stock in the portfolio. And then one or two slightly more surprising names, but have really performed well. One is Flutter, Paddy Power Betfair, which has again been one of the laggards in the portfolio for a sustainable period of time. The interesting thing about Flutter is, sports betting has shut down. There's been no live sports for the last two months. You would have thought counterintuitively that a stock like that would actually deteriorate or the price would drop. But a large portion of the performance in Flutter recently has been the merger with Stars Group, which is the big Canadian company. And Stars Group is all online, and predominantly they have 40% in poker. And poker over this period has shot the lights out. And we were, again, slightly fortuitous in the sense that we thought there may be competition issues with the CMA in terms of allowing the merger of these two entities, because they've got Sky Bet, which predominates about 30% of the UK market, and you've got obviously Paddy Power on their side. And we thought there may be issues with them in the UK and in Australia. But the CMA came out a few weeks ago and said, we have no issues. Australia said they have no issues. And the deal has actually been brought forward. And as of the 5th of May, it's now become one entity. And the market's been buoyed by a few factors. One is Stars Group numbers have been way ahead of expectation, which has kind of saved the earnings in the short term. But why we're very excited about Flutter is the US opportunity. And they, we believe, are second to none in terms of the sports betting opportunity in the US. And if you look at another company called DraftKings, which is a SPAC in the US, it's basically a cash shell. The stock's doubled in the last 4 weeks as the market's got no other entities to kind of buy with exposure to sports betting in the US. So we think Flutter is very well positioned for the future. Optically, the stock looks very expensive, but you need to understand the sum of the parts. If I then just skip to kind of the narrow band within the middle, the holding side of the portfolio, we have companies like Cigna, HCA, Front Door, and Imperial. And Imperial's interesting because, if you think structurally, Imperial's a stock that's declining. You have tobacco sales that keep declining. It's been typical of what we wanted it to be in the portfolio: defensive, low beta, and something that consumers will go out and spend money on. And on a relative basis, it's been a great outperformer in this period of time. But I think going forward, if we saw Imperial share price up, I don't want to give you a number, but maybe 15 or 20%, we may look to come out of it, certainly in the best ideas portfolio, but retain it in the dividend growth portfolio, just because I think the opportunity out there of other higher growth companies are around. And it served its purpose in the one sense. So it's something we're considering going forward. But I think in dividend growth, it's likely to remain. And on that note, if you think about what's going on in the FTSE and around the world, it's difficult to see any companies actually paying out a dividend over the next 12 months. I was toying with Dion a few weeks ago, calling our best ideas our dividend growth portfolio the last man standing portfolio, because everyone's cut their dividends. Royal Dutch Shell, you might have seen at the beginning, the end of last week, big shock. The market was up in arms. I don't think it was unexpected. And I think you could expect something from BP as well, but it won't be a complete cut. I think it'll be a partial cut. So I think, if you're thinking about dividend growth, I think you've just got to put that idea on hold for the foreseeable future. And at some stage, there'll be a reset, and then there will be growth. So it's also something we're considering. But I think Imperial, from that point of view, has been phenomenal. If we then go to, the slightly more problematic side of the portfolio, or the portfolios or the stocks that have been hard hit, that are likely to recover or may not recover. And this is where we spent most of our time in terms of weeding out what we think are potential issues. And we can identify them really in four sectors. The one is the financials. And one can understand, obviously, why financials have been hit. Interest rates have been slashed to zero. The net interest margin for banks is gone. And then you have this additional worry about defaults, mortgage repayments, defaults, etc., credit card. So you can understand why Wells Fargo has been slashed. And it's been frustrating because not only has it been a bad performer going into this relative to the banking sector, but it's now had a double whammy of being hit back. On the flip side, what is beneficial is the fact that because they were constrained by the Fed and other regulators, they actually didn't borrow or lend as much money as some of the other banks. So the exposures have been slightly more limited, and they have very strong discipline in terms of that. So we remain comfortable. I say comfortable. I mean, you never know what's going to happen in the States. You don't know how long this is going to happen, and you don't know how long the severity is going to be. But what I would say is that, Wells is one of the better placed banks in the States in terms of capital structure. And because of the liquidity that you're seeing in the markets right now, I don't think there's going to be any big banking failure, at all. So you may see it in the dog box for a while. No one wants to be in banking stocks. No one wants to be insurers. No one wants to be in airlines. No one wants to be in autos. These are unloved companies. And therefore, I say these are the kind of stocks that may surprise you on the upside when, the news flow comes out and hold on, people are actually paying their mortgage. The small, medium businesses haven't gone bust. The oil companies, they had no exposure to them. And this may happen. So it's hard to quantify. But we think on a relative basis, the stock is quite inexpensive. But there's a black hole there that we just can't quantify. And then Arch Capital and Chubb, I would pretty much put in the same kind of basket. They are two large insurance companies in the US. Arch is a reinsurer. They both have exposure to business interruption insurance. And that's become a big topic worldwide in terms of, is the pandemic covered by business interruption insurance? Does there have to be specific wording? And how do you quantify that? How many businesses, what are you going to pay out for? So what the market has basically done. It's just sold off the entire sector. It's thrown out, the baby with the bathwater, so to speak. And again, it's very difficult to quantify, but what we've tried to do is go through the various parts of the business model and see how much exposure each of these companies actually has to business interruption insurance, and see what the liabilities are likely to be. On top of that, there's still a lot of legal wrangle happening in the world, and the Hiscox is a very good example in the UK. They've basically come out and said that business interruption insurance is not covered by the normal terms of insurance, and if it was, it can't be, because the market hasn't priced that kind of risk into it. And if they had to price it in, the premiums would have skyrocketed. And if they all have to pay, basically, it will wipe out the industry. And that's the view Hiscox have taken. Up until Friday, the FCA and the US authorities actually said we're not getting involved. But the FCA is now launching an inquiry into this, because there are a lot of small business holders that are obviously relying on this insurance and they're not getting paid out. So it's opaque. There's going to be a lot of legal wrangle. But in the meantime, from our point of view, we think Arch, certainly Chubb, are diversified businesses. The stock prices have effectively halved. They've bounced to a degree, and they're in the kind of wait and see bucket, and we're unlikely to sell them. But we do understand why there is negativity to it. And I'll throw Prudential into the same bucket, because Pru, if you compare Pru to AIA, you would think, well, why is the share price done so badly? And to just remind you, Prudential now is compromises two sides of the business. You have the Asian side of the business, which is a comparative to AIA. It's a flourishing business that has a very profitable profile. And then you have Jackson Financial, which is the US side of the business. And Jackson Financial, you should think of probably as an asset management type of business. They have life annuities and variable annuities, and they have certain liability matching to take place. So as the market has dropped, as interest rates has dropped, the liability matching has gone out of kilter. And that's kind of pulled the valuation of Prudential down. But we look at it and we think, at the moment, there's so much negativity in Jackson Financial, and there's also talk from Prudential. They're talking about a potential IPO or certain fundraising on that side, and trying to move it out of the business to try and get a re-rating of the of the Asian side of the business. So we think the stock's cheap. We think you're getting basically the US business effectively for nothing, and we remain comfortable on Prudential. So we understand the risk in the financial side, or the slither of the portfolio. Then we have the industrials, and within that bucket, I've included UTX, which is now Raytheon, Otis Lifts, and Meggitt. And these stocks initially we were very concerned about. So UTX split as we anticipated, and they split into three parts. We had Carrier, we had Otis, which is the lifts part, and then you have Raytheon Aerospace. And because our anticipation is that the airline industry is basically going to be structurally challenged for the foreseeable future, probably the next 3 to 4 years, anything associated with that will be negatively impaired. And if you think the company like Meggitt and UTX service the commercial aerospace sector, you can see why there was so much negativity. If you compound that by a company like Meggitt that had quite significant gearing, and to a less degree UTX, but they were both quite significantly geared, you can understand how the stock prices absolutely capitulated. But on further analysis of Raytheon, because they've now merged the old UTX business with the Raytheon defense business, we've come out quite comfortable with the position, in the sense that now Raytheon, as it sits, compromises 60% defense, and defense spending actually has not budged. It's actually only down 5% quarter on quarter, and we think it's likely to remain strong and buoyant. And then you have the 37 or 40 odd % in commercial aerospace, which has been negatively impaired. But comparing the businesses now that you've put together, again, to relative other companies in the space, you're paying about a 3 times multiple for the aerospace side of it. And you're getting the defense stock, which is the defense side, which is relatively bulletproof or defensive. um, at a relative valuation. So we're actually very comfortable with Raytheon, and it's kind of stock in a fund. If it got a little bit cheaper, we would look to add to. Talking again about what additions we made to the portfolio, the only stock we actually did add during this period was increasing our exposure to Otis Lifts. Now, Otis is an incredible business in the sense that you have huge visibility of earnings. It's like Rolls-Royce in a way. You sell someone a razor, and then you have to keep servicing the blade. So they put elevators and escalators into buildings, and because of regulations, these buildings have to be serviced every 6 months or whatever. So they have service contracts with all the companies. So you have a very strong visibility of earnings in the main. Clearly, the question marks about building and construction, where that's going to go in the future, and if there's going to be a reduction in the amount of just general overspend around growth areas. But comparing them to the European peer group, and there's really two other market leaders. They are one of three. You have Kone and you have Schindler's, and they both trade at a significant premium to Otis. And Otis, because it's come out of a spin out, people still are trying to work out, who are Carrier, who is Otis, who's this Raytheon. Some people have dumped the stock. So we thought and consider to think that long term, this is a great business. It's actually a compounder over a period, and we're looking 3 to 5 years out, and we're not listening to the short term noise. So we've added it to the dividend growth portfolio and think it's quite a sustainable dividend yield, and on a relative basis, the valuation is fine. And then we have Meggitt, and Meggitt I've kind of touched on the Raytheon basis. Meggitt has more exposure to the aerospace sector. 60% of their business is commercial aerospace, 37% is defense, and they are leveraged. So Meggitt is a problem. It's a stock that we continue to monitor. The price was one of the best performing stocks in the portfolio last year in 2019. It's dropped from £7 down to a low of, I think, 220. It's now trading around 260, 270. There's too much negativity in the stock, and we're hoping for some kind of bailout for the airlines. You might see Boeing or Airbus or even some of the big aeroplane companies get some stimulus, and I think that will lead to a catalyst. But we are under no illusion that Meggitt for the foreseeable future is a problem. Now, maybe there's a short-term bounce we may cut, but we are monitoring it. It's kind of in intensive care, and we'll watch that. But thankfully, I would say that's really the only stock in the portfolio that concerns us. Then we have another interesting sector, which is leisure. And within the leisure part of the portfolio, we have Disney, and we have Madison Square Gardens, and we have Crown Casinos. And we, again, spend hours looking at these stocks thinking, are we mad? Why do we own stocks where theme parks for the next 6 months could be shut, where cinemas could be shut, where Disney can't throw their biggest blockbuster movie? Why, when you've got 60% of their business that could be impaired for the foreseeable future, why do we not sell and try buy back cheaper? And then you have the other 30-40%, which is, again, structurally being impaired, but something we know about. And then you have kind of the lining on the other side, which is Disney Plus, which has been phenomenal. It's over the last 6 months, the subscriber growth has gone from 0 to 60 million. That's 60 million, which is way above anything they anticipated. If you look at Netflix, it's taken them at least 5 to 6 years to grow their subscriber growth to just short of 200 million. And Disney have done this in 6 months. So we think they have a very viable business model. It is loss making, but we think they have a great business. But just going back to the theme parks and the movie side. So what they're trying to do on the movie side is they're actually starting to move a few of the movies onto digital, which will bring in cash flow, but not the significant cash flow they're looking for. But Disney's the kind of company, when you look and you think, who's going to go bust? Even if markets were shut and we went back to the days just before the bottom of the market, Disney is a company with iconic brands that no matter what would always be able to raise finance. In fact, they raised $6 billion a few weeks ago at very, very attractive rates. So we think they've got significant cash. They can shut their businesses for a year even. And yes, the share price will drop somewhat. But it's the kind of company that, if you saw it down at $80 from, say, 108 to 110, where it is now, we would be backing up the truck on a company like Disney. So we remain very comfortable on Disney. And then MSG or Madison Square Gardens is also fascinating. And you need to think of the valuation and mindset of Madison Square Gardens slightly different to what you would think of a normal operational leisure business. So Madison Square Gardens now has, again, split into two groups. You have the Madison Square Gardens Sports, and you have the Madison Square Gardens Entertainment. And in the sports, you have two effective franchises. You have the New York Knicks, which is the biggest basketball franchise effectively in the States, and then the Rangers, which is an ice hockey team, and then a few ancillary franchises which aren't relevant. And if you got to think about this company as a trophy asset. If someone comes to you and says, 2 months ago, Manchester United was valued at $7 billion. Today, it's valued at $4 billion. If I'm, I don't know, a hedge fund billionaire, or if I'm a sheik, and I want a trophy asset at a discount, I will go and buy it, because it doesn't matter if business is shut for the next 6 months. You're buying something that is unique. And on top of it, these individuals that buy these trophy assets get a tax write-off. They're able to write off $125 million a year against their personal expenses for 12 years. So this is why a guy like Steve Ballmer, goes and buys a hockey team or an NFL team. And therefore, we think, now what's happened is, since the split and since there's been a discount in the stock, you have the opportunity to buy a great franchise at a big discount. And you have a lot of people or smart money that's moved into it. You have Silver Lake, which has taken a 10% stake. And we had another fund that took a 5% stake. They are taking stakes in this business because there will be some transaction in the foreseeable future. So I think you just got to, in a way, just watch the share price, look at an intrinsic value type of thought process there. And as I say, we remain comfortable, and it doesn't matter if the Knicks don't play basketball for the next 6 months. As it happens, they're talking about reinstating basketball at the end of the year, and it will go on national TV, and they will start operating again. And then you have
from a property perspective. Sorry, Joe. From a property perspective, I might be mistaken, but is it not so in terms of the Madison Square Gardens property? They own that airspace as well. Is that not
correct?
So
Madison Square Gardens is in the entertainment side of the business. So the sports, I was talking about the sports side there, which are the two big sporting franchises, and then you have the smaller portion. And on a relative spin, it's basically a third to two-thirds. So the one stock spun out at about $180 now, and the other one's trading at $80. And that's the ratio. The $80 portion of the stock is the Madison Square Gardens Entertainment. And that's the Madison Square Gardens Arena. And they have a few smaller theaters in Boston and other areas. And they have a live entertainment side of the business as well. And again, that business is impaired for the foreseeable future. You just don't see how gatherings of more than 500 people are going to take place for a while. And you kind of think, well, this business could be impaired, cash flows could disappear. And then to complicate the issue slightly more is Madison Square Gardens Entertainment are building a new exhibition theater in Las Vegas called the Sphere. And they're looking at doing one in London as well. And they've actually just put that on hold. The saving grace for MSGE, the entertainment side, is they have significant cash on their balance sheet, which they've now said, we're just going to put this project on hold. So to your point, the Madison Square Gardens Arena is an iconic arena. It is potentially the best in the world in terms of where artists want to play. On top of it, you have, as you said, the property. They have sports betting rights. There's a lot of levers that can get pulled. But in the short term, I think all bets are off. And you will get a net asset value play. So I think, again, if that stock price starts moving down, they are a survivor. They are a trophy asset. And if you put the two sides together, we think they are two great businesses. My preference would be to be on the sports side of the business, though, because I think that's a no-brainer in terms of valuing the business, understanding what's there, and seeing where the premium is. Whereas on the entertainment side, we don't know how long the duration of the lockdown will continue. We don't know how long live entertainment may not happen. And there are also question marks about the spending the company has around the Sphere and the success of the Sphere project, which is only likely to happen now it's going to be pushed back to 2022. And going forward, I think we would probably retain MSG Sports in the portfolio, and maybe, depending on pricing, look to exit the entertainment. But it's something under review. And then lastly in that bucket is Crown Casinos, which is predominantly Australian-based. Compared to Las Vegas Sands, Crown Casinos has a balance sheet of about 500 million of cash. They had debt facilities of $1 billion, and they're building a casino in Sydney as we speak. And they've actually come back. They furloughed a lot of their customers. They furloughed a lot of their staff, and they've actually come back to the market and said, we haven't put our project on hold. We're going full steam ahead. And what gives us a little bit more confidence, if you look at New Zealand and Australia, they've gone back to business as usual. They've contained the virus. They've almost eliminated the virus, so to speak. And we think that Crown Casino is actually quite undervalued. And on top of that, we think it's very viable or foreseeable that there could be a bid for the company from either Malco, Las Vegas Sands, or Wynn, because they need these trophy assets, which are in Australia. So it's a stock we've added to in our fund, which is a different product to I'm talking to today, but we remain very confident on it. So we're comfortable with that. And then lastly is oil, something we haven't spoken about. You mentioned earlier on in the beginning of the chat. Again, a fascinating play that's going on in oil. I didn't even know that oil could go into negative on a futures contract. We own BP. In terms of our general oil exposure, it's only 5% of the portfolio, so it's relatively low. BP is a survivor. It has access to capital. It has a balance sheet. It went through this kind of crisis when you had the Macondo oil spill. They know how to rationalize their business. They know how to cut spending, and that's exactly what's happened. The oil majors, the shale industry, most oil companies can't function with an oil price certainly below $45 a barrel. The Saudis can at 10 in specific situations, the Russians possibly, but shale certainly can't. So you're going to see a rationalization taking place where you have the supply side of the curve being shut down by OPEC and the dysfunctional allies, but they were all doing it. Norway has now joined the party because they have to. And then the bigger issue is actually the demand side of the curve. Historically, coming in the last decade, you've always had strong demand, whereas now demand has capitulated. And I think the rebalancing in the oil price is going to take a significantly longer period of time. But again, there's so much negativity in the oil stocks now that I think if you wanted to see where big gains are going to come over the foreseeable future, you could actually take a dip in some of the oil companies. It's not for this portfolio. It's not something we're going to buy because we don't have a 3 to 5 year visibility on oil stocks. But certainly from a BP point of view, we think they are a survivor. There will be mergers and acquisitions. They will take advantage of the situation and they have access to capital. And they may just cut their dividend in the short term. But that's an expectation that we've already built in. So we are very comfortable. So that's kind of how the portfolio sits today. And if you kind of, again, think of the front end, defensive, back end, variable, and you could probably see most of the performance in the next 18 months come on the back end from better, I think, expected news flow or understanding what's going on. So we're not prepared to really do anything. I think Megget's problematic, and that could be one that comes out. And as I said, Imperial's another one that we're monitoring. But we are comfortable. And then in terms of going forward or what we, fear of missing out, we were about 2 days away from pulling the trigger on 2 stocks on our portfolio. One was a large IT company, platform business, and it got away from us. And we've held our discipline. And the other one was a payment provider, which is a sector we do want to get into, but the valuations of companies like PayPal and Visa have just gone back to basically where they've gone before. So we've missed out on them. But those are 2 stocks. One was Facebook, the other one was Visa, actually. Well, either Visa or PayPal. Those are 2 sectors that we want to be back in. And actually, Facebook on a relative basis doesn't look that expensive. Google doesn't look that expensive. But we are monitoring the situation. We'd like to see a bit of a pullback in these stocks, and you may see an addition of one of those 3 or 4 names in the portfolios. But a lot changes in days and weeks. But we are monitoring, as I say. we're comfortable holding cash. And I think in the short term, the markets probably have rallied a little bit too hard too quickly. And I think depending on the success of the rollout of the exit strategies of various countries, you may or may not see certain stocks or sectors bounce back a bit quicker than others. But, this is the frustrating thing, or not frustrating, just in terms of our investment philosophy. We like to buy stocks in a 3 to 5 year view, but a lot of the fundamental analysis that we've done in the past going into stocks has changed. And you've had to think very differently about survival mode. How do businesses operate in a lockdown environment? Do they have revenue? Do they have cash flow? If they don't, do they have access to cash? Are they iconic brands? Will they be around? There's a lot of moving parts to it. So the process has changed slightly. And also the other very difficult aspect in terms of analyzing these businesses is that the E in the PE has disappeared. Earnings for 2020 or going to 21 are absolutely decimated. So on a relative basis, you can't really, you can't value companies anymore. So you've got to kind of take a philosophical view on the one hand and an intuitive view on the other hand, in terms of, I don't mind overpaying in the short term because that is just an anomaly in earnings. But we think, it's a stronger business. It's going to be a better business. Its competitors have now disappeared, unlikely to come back. These are all aspects that come into the investment process that we look at going forward. And therefore, it's become, it's been fascinating, interesting. We've had some, soul searching at times. But we feel that we're in quite a comfortable space right now, irrespective of the fact that, intrinsically the portfolio hasn't changed significantly.
So, Jade, from a style perspective, I think you mentioned a few points. Obviously, initially, Credo, stood by the value sort of bias in terms of your style. But I think what you've now pointed out is maybe there is a bit of a tilt to more a quality sort of look during these sort of cycles. And I think that's a take home for me here. I think what is imperative for me is to understand that one is not necessarily set in your ways. Times have changed, and we're adopting new ways of thinking, relative to our old ways. And so thank you very much for your input. I really do appreciate both gentlemen. I mean, it's always a pleasure, spending time in your presence. So thank you for that. I'm going to touch base soon. But yeah, thanks for the input and the comfort that you guys have given us today. If there's any questions, I might communicate that electronically if you don't mind.
Of course. Thank you.
Pleasure. Thank you very much.
Thank you, gentlemen. Take care now.
Okay. Bye-bye.
Thank you. Bye-bye.